On Monday, February 23rd, 2026, while the stock market was imploding, silver did something absolutely insane. It surged 6% in a single day to $87 per ounce. That's one of the biggest one-day moves in silver we've seen this entire decade. And it happened while the Dow Jones crashed 771 points. The S&P 500 dropped 79 points, and the Nasdaq fell 326 points. If you own stocks, you lost money on Monday. If you own silver, you made money. And the reason why comes down to three words: tariff chaos returned. Hi, I'm Roxanne, and in the next few minutes, I'm going to break down exactly what happened over this wild weekend, why silver exploded while stocks tanked, what this means for gold hitting $5,200, and whether you should be buying precious metals right now or waiting for a pullback. This is not speculation. This is breaking news with verified data. And by the end of this video, you'll understand why precious metals just became the most important asset class to watch in 2026. Let's get into it. To understand Monday's chaos, we need to start with Friday, February 20th. The United States Supreme Court issued a 6-3 ruling that struck down President Trump's reciprocal tariffs that had been imposed under the International Emergency Economic Powers Act, or IEEPA for short. These tariffs had been in place for over a year and covered imports from countries all around the world. The court ruled that Trump exceeded his authority when he used IEEPA to impose these sweeping trade taxes. Now, when the ruling first came out on Friday afternoon, the stock market actually rallied. The Dow gained 230 points. The S&P 500 rose 0.69%. The Nasdaq jumped 0.9%. Investors thought this was great news because it meant lower costs for companies that import goods. But here's what changed everything. Over the weekend, Trump responded. On Saturday, he announced via Truth Social that he would be using a different legal authority, Section 122 of the Trade Act of 1974, to impose a new 10% global tariff. Then, on Sunday, he raised it to 15%. So in the span of 48 hours, we went from tariffs being struck down to new tariffs being implemented at an even higher rate. And this time, the tariffs would last for 150 days while Congress decides what to do. Markets hate uncertainty. And what Trump just did was create maximum uncertainty. When markets opened on Monday morning, reality set in. The Dow Jones Industrial Average dropped 771 points. That's a 1.56% loss in a single day. The S&P 500 fell 79 points and the Nasdaq Composite dropped 326 points. This was not a small pullback. This was broad-based selling across every sector. 9 out of 11 sectors in the S&P 500 were down. The ratio of declining stocks to advancing stocks on the New York Stock Exchange was 1.33 to 1, which shows just how widespread the bearish sentiment was. Individual stocks got hammered. American Express dropped almost 8%. Nike fell 5%. JP Morgan Chase lost 4%. Goldman Sachs dropped 4%. These are blue chip companies, and they were getting crushed because investors realized that a 15% global tariff is going to hit corporate profits hard. But while stocks were tanking, something else was happening in the commodities market. Silver absolutely exploded on Monday. It surged 6% in one day, climbing from around $82 to $87 per ounce. That is one of the most volatile single-day gains we've seen in silver in years. To put that in perspective, gold rose about 2% on the same day to hit $5,200 per ounce. That's a strong move for gold, but silver outperformed it by 3-1 on a percentage basis. Why did silver move so aggressively? There are 3 reasons. First, safe haven demand. When stocks are crashing and uncertainty is spiking, investors flee to assets that hold value during chaos. Gold and silver are the classic safe haven trades, and Monday proved that playbook still works. Second, the dollar weakened. The Supreme Court ruling and Trump's chaotic response put downward pressure on the US dollar. When the dollar falls, precious metals priced in dollars become more attractive to international buyers, and prices rise. Third, and this is critical, silver is in its sixth consecutive year of supply deficit. The Silver Institute estimates that 2026 will see a shortfall of 67 million ounces. That means demand is outpacing supply, and when you layer safe haven buying on top of an already tight market, prices spike. Silver mining stocks followed the metal higher. Hecla Mining was up 2.2% in pre-market trading. Kerr Mining gained 1.4%. Canadian miners like Endeavour Silver, Silvercorp Metals, and Wheaton Precious Metals all posted gains between 2% and 2.4%. The silver ETFs also surged. The ABRDN Physical Silver Shares ETF and the iShares Silver Trust both gained 2.3% on Monday. This was a massive divergence. Stocks down, silver up. And that tells you something important about where smart money is moving. While silver was making headlines with its 6% surge, gold quietly pushed above $5,200 per ounce. That's a 3-week high for gold, and it's within striking distance of the all-time record gold price we saw in late January. Gold's move on Monday was driven by the same forces as silver: safe haven demand, dollar weakness, and uncertainty around U.S. trade policy. But there's an added layer for gold. Central banks around the world have been buying gold hand over fist. They're diversifying away from the US dollar because they're worried about the stability of the dollar as a reserve currency. JP Morgan analysts came out this week and said they expect gold to reach $6,300 per ounce by the end of 2026. That's a 30% gain from current levels. Their reasoning? Gold is a hedge against multiple risks right now: trade war escalation, fiscal deficits ballooning, geopolitical tensions with Iran, and the erosion of confidence in fiat currencies. Gold doesn't pay interest. It doesn't generate cash flow, but it also doesn't have counterparty risk. When you own physical gold, you don't have to trust a bank, a government, or a corporation. You just own the asset. And in a world where the Supreme Court is striking down tariffs one day and the president is imposing new tariffs the next day, that lack of counterparty risk is incredibly valuable. Here's the part of this story that's not getting enough attention. When the Supreme Court struck down Trump's tariffs, it didn't just eliminate future tariff revenue. It potentially put $175 billion in already collected tariff money at risk of being refunded. The Penn Wharton budget model at the University of Pennsylvania estimates that companies who paid these now illegal tariffs could demand refunds. Some analysts put that number as high as $175 billion. Morgan Stanley thinks it's closer to $85 billion. Others say it could be between $100 billion and $130 billion. But here's the problem. The U.S. federal government's budget deficit for fiscal year 2026 was already sitting at $600 billion as of the end of January. If you add $175 billion in tariff refunds on top of that, you're looking at a $775 billion deficit, and we're only a few months into the fiscal year. Maya McWhinney, president of the Committee for a Responsible Federal Budget, said it bluntly: "We are in a dismal fiscal situation, and it just got worse." The One Big Beautiful Bill Act that Trump passed earlier this year was supposed to be offset by tariff revenue. But now that the Supreme Court has struck down those tariffs, that offset is gone. The bill still spends the money, but there's no revenue to pay for it. This is a fiscal disaster in the making. And when governments run massive deficits, they typically print money to cover the gap. And when they print money, inflation goes up. And when inflation goes up, precious metals go up. That's why gold and silver are surging right now. The market is pricing in the fiscal consequences of this Supreme Court ruling, and those consequences are ugly. The chaos isn't just domestic. The Supreme Court ruling and Trump's response have thrown international trade into complete disarray. Bernd Lange, chairman of the European Parliament's Trade Committee, called the situation pure customs chaos. He's proposing that the European Union suspend its trade agreement with the United States until there's clarity on what the actual tariff policy is. India postponed trade talks that were scheduled for this week. They were supposed to finalize an interim trade deal with the US, but now they're holding off because they don't know what the tariff environment will look like. Gold priced in euros rose 0.9% to a 3-week high above $376 per ounce. Gold priced in British pounds also hit 3-week highs above $3,027 per ounce. This is a global story. The US is the world's largest economy, and when the US throws tariff policy into chaos, it affects every trading partner. Companies don't know what their costs will be next month. They don't know if they should import goods now or wait. They don't know if the 15% tariff is going to stick or if it's going to be challenged in court and struck down again. And when companies can't plan, they pull back on spending. And when they pull back on spending, economic growth slows. And when economic growth slows, investors get nervous and move money into safe haven assets. That's the cycle we're in right now. Let's talk about why silver surged 6% while gold only rose 2%. Silver is what analysts call a high beta play on gold. That means it moves more aggressively in the same direction. If gold is up 1%, silver might be up 2% or 3%. If gold is down 1%, silver might be down 2% or 3%. Why? Because silver is a smaller market than gold. The total value of all the silver in the world is a fraction of the total value of all the gold in the world. That means it takes less money to move the silver price. But there's more to it than just market size. Silver has a dual identity. It's both a precious metal and an industrial commodity. About 60% of silver demand comes from industrial applications. Solar panels, electric vehicles, electronics, semiconductors, all of these use silver. And as the global economy builds out more renewable energy infrastructure and more advanced technology, industrial silver demand keeps climbing. So when safe haven buyers pile into silver at the same time that industrial demand is strong, you get explosive price moves like we saw on Monday. The gold to silver ratio also tells an interesting story. Right now, that ratio is sitting around 60-1. That means 1 ounce of gold is worth about 60 ounces of silver. Earlier this decade, that ratio hit 104-1. The fact that it's come down to 60-1 shows that silver is catching up to gold. It's re-rating itself based on its scarcity and its essential role in modern technology. Some analysts think the ratio could compress even further. If it goes to 50-1 or 40-1, that would imply significantly higher silver prices. While gold and silver were surging, Bitcoin fell. Bitcoin dropped 2.65% on Monday to around $65,771. It dipped below $65,000 intraday before recovering slightly. This is important because it shows that Bitcoin is not behaving like a safe haven asset. It's behaving like a risk asset. When stocks crash and uncertainty spikes, Bitcoin falls. It moves with the Nasdaq, not against it. That tells you that investors do not view Bitcoin as digital gold. They view it as a speculative tech play. Gold and silver, on the other hand, moved in the opposite direction of stocks. They went up when stocks went down. That's what safe haven assets are supposed to do. I'm not here to bash Bitcoin, But if you're looking for an asset that protects you when markets panic, the data from Monday is clear. Gold and silver did their job. Bitcoin did not. So where does silver go from here? Analysts are divided, but most are bullish. The Silver Institute is forecasting that 2026 will be the sixth consecutive year of supply deficit. They expect a shortfall of 67 million ounces. Even though solar manufacturers are trying to reduce the amount of silver they use per panel, a process called thrifting, demand from AI data centers, electric vehicles, and advanced semiconductors is making up for it. Some analysts think silver could hit $100 per ounce again this year. It already touched $120 in late January before crashing back down to the low 70s. The question is whether the next run to $100 will stick or if it will be another speculative spike followed by a crash. JP Morgan's research team is more cautious. They're forecasting that silver will average $81 per ounce for 2026, which is where we are right now. But they're also warning about volatility and the risk of substitution technology in the solar industry. The key technical level to watch is $85. If silver can hold above $85 and consolidate at these levels, the next move could be toward $92 or even back to $100. But if it falls below $82, we could see a pullback to $75 or lower. Okay, so the big question, should you be buying silver at $87 per ounce? Here's my take, and I want to be very clear that this is not financial advice. I'm not a licensed financial advisor. This is just my analysis based on the data. If you believe that trade war uncertainty is going to continue, that fiscal deficits are going to keep growing, and that safe haven demand for precious metals is going to stay strong, then silver at $87 is a reasonable entry point. But you need to size your position appropriately. Silver is volatile. It can surge 6% in a day, but it can also drop 6% in a day. If you can't stomach that kind of volatility, silver is not the right investment for you. Most financial advisors recommend capping your precious metals allocation at 10% to 15% of your total portfolio. And within that allocation, silver should be a smaller portion than gold because of the higher volatility. If you're going to buy silver, I would suggest dollar cost averaging. Don't dump a lump sum in right now. Buy a little bit at $87. If it drops to $82, buy more. If it drops to $75, buy even more. That way, you're averaging out the volatility and not trying to time the exact bottom. And for the love of all that is holy, do not use leverage to buy silver. Do not buy it on margin. Do not borrow money to buy it. This is a volatile asset, and if you're using borrowed money, you can get wiped out in a single day. Physical silver is the safest way to own it. Coins, bars, rounds, anything you can hold in your hand. That eliminates counterparty risk. If you don't want to deal with storage, silver ETFs like SLV or SIVR are options, but understand that you're trusting a custodian to hold the metal for you. In a real crisis, you might not be able to redeem your shares for physical metal. Silver mining stocks are another option, but they're even more volatile than the metal itself. They can give you leverage to silver prices, but they also come with company-specific risks like management quality, mining costs, and geopolitical issues. Let's talk about the risks, because there are real downsides to owning silver. First, volatility. Silver can crash just as fast as it can surge. In late January, it hit $120 per ounce and then dropped nearly 50% in 2 weeks. If you bought at $120, you're still down 27% even after Monday's 6% surge. Second, substitution risk. Solar panel manufacturers are actively working to reduce the amount of silver they use. If they succeed in developing copper-based alternatives or thin film technologies that don't require silver, that could cut a huge chunk of demand out of the market. Third, no yield. Silver doesn't pay dividends. It doesn't generate cash flow. It just sits there. If you own silver for 10 years and the price doesn't move, you've made zero return. Compare that to a stock that pays dividends or a bond that pays interest. Fourth, government risk. In 1933, the U.S. government confiscated gold from American citizens through Executive Order 6102. They forced people to turn in their gold at a fixed price and made it illegal to own gold bullion. Could they do that with silver? It's unlikely, but it's not impossible. Fifth, storage and insurance costs. If you own physical silver, you need to store it somewhere safe. That could be a home safe, a safe deposit box, or a private vault. And you probably want to insure it, which adds to your costs. These risks are real. I'm not going to sugarcoat them. Silver is not a risk-free investment. But neither are stocks. The Dow dropped 771 points on Monday. That's not risk-free either. The question is which risks you're more comfortable taking. If you own silver or you're thinking about buying it, here are the things you need to be watching over the next few weeks. First, watch the dollar. Silver and the dollar have an inverse relationship. If the dollar continues to weaken, that's bullish for silver. If the dollar strengthens, that's bearish. Second, watch the Supreme Court. Trump's new 15% tariffs are almost certainly going to be challenged in court. If the courts strike them down again, that could trigger another round of market chaos, which would be bullish for precious metals. Third, watch industrial demand data. The Silver Institute publishes quarterly reports on silver supply and demand. If industrial demand stays strong despite thrifting efforts, that supports higher prices. Fourth, watch the Federal Reserve. If the Fed starts cutting interest rates, that's bullish for precious metals because it lowers the opportunity cost of holding assets that don't pay yield. Fifth, watch geopolitical tensions. There are reports that the U.S. and Iran are having talks this week in Geneva. If those talks break down and military tensions escalate, that would be bullish for safe haven assets. And sixth, watch the gold to silver ratio. If that ratio continues to compress toward 50-1 or lower, that implies silver is outperforming gold, which is a strong bullish signal. Let me zoom out and give you the big picture. What happened on Monday? Silver surging 6% while stocks crashed 771 points is not a random event. It's a symptom of a much larger shift happening in the global financial system. We're in an era of massive fiscal deficits, rising geopolitical tensions, trade war uncertainty, and eroding confidence in fiat currencies. Central banks are buying gold at record levels. Investors are piling into precious metals as a hedge against chaos. And the chaos is not going away. The Supreme Court just threw U.S. trade policy into disarray. Trump responded by imposing new tariffs that will almost certainly be challenged in court. Europe is threatening to suspend trade agreements. India is postponing negotiations. This is not a stable environment. And in unstable environments, people move money into assets that have held value for thousands of years. Silver has been money for 5,000 years. It survived the fall of the Roman Empire. It survived every banking crisis, every currency devaluation, every monetary reset in recorded history. And it's doing exactly what it's supposed to do right now. While stocks are crashing, silver is surging. Silver exploded 6% on Monday to $87 per ounce, while the Dow crashed 771 points and the S&P 500 dropped 79 points. Gold hit $5,200. Bitcoin fell below $66,000. The Supreme Court struck down Trump's tariffs. Trump responded with a 15% global tariff. Markets panicked, and precious metals did exactly what they're supposed to do. They went up when everything else went down. If you own silver, Monday was a good day. If you own stocks, it was a bad day. And the divergence between those two asset classes is only getting wider. Now I want to hear from you. Are you buying silver at these levels? Are you waiting for a pullback? Do you think we're going to see $100 silver again this year? Or do you think we're headed for another crash? Drop a comment below. I read every single one, and I want to know what you're seeing in your portfolios. And if you found this breakdown valuable, hit that like button, subscribe to the channel, and share this with anyone who's trying to figure out whether they should be holding precious metals right now. Because this market is moving fast, and you need to stay informed if you want to make smart decisions with your money. I'm Roxanne, and I'll see you in the next one.